Is Apple stock still a must-have for your portfolio in 2025? With a $3 trillion market cap, record-breaking earnings, and new AI innovations, Apple stock is making waves. But tariffs and regulatory risks are raising eyebrows. Should U.S. investors buy, hold, or sell Apple right now? Stick around for our in-depth analysis to find out if Apple is your next big investment. Let's get started. Let's kick things off with Apple's financial performance, because the numbers tell a powerful story. Apple's fiscal third quarter for 2025, reported on July 31st, was a standout. The company posted $94 billion in revenue. That's a 10% jump year over year, the biggest quarterly growth since December 2021. Earnings per share came in at $1.57, up 12%, beating Wall Street's expectations of $1.43. The star of the show? iPhone sales. They hit $44.6 billion, up 13%, thanks to the iPhone 16 family. Macs also performed well at $8 billion, beating estimates, while iPads slightly missed at $6.6 billion. The services segment like Apple Music, iCloud, and Apple TV Plus hit a new record, though exact numbers weren't shared. Analysts predict services could make up 25% of Apple's revenue by the end of 2025, crossing $100 billion annually. That's huge for profitability, since services have higher margins than hardware. But it's not all smooth sailing. Apple faced $800 million in tariff costs in Q3, and they expect that to climb to $1.1 billion in Q4. These costs could squeeze margins, especially since Apple relies heavily on global supply chains, particularly in China. Still, CEO Tim Cook said, "Our active device base reached an all-time high across every product and region, driven by unmatched customer loyalty." That's a sign of Apple's staying power. For U.S. investors, these numbers show Apple still firing on all cylinders, but those tariff costs are worth watching. What do you think, bullish or cautious on Apple's earnings? Now, let's talk valuation. Is Apple stock priced right, or is it too expensive for U.S. investors? As of August 1st, 2025, Apple stock is trading around $208, with a market cap of $3 trillion. That's massive. But the key number to watch is the price-to-earnings ratio, or P/E, which sits at 30.76. What does that mean? P/E of 30.76 is higher than the tech industry average, suggesting Apple might be fully valued or even overpriced. It reflects investor confidence in Apple's future growth, but it also means you're paying a premium for every dollar of earnings. For comparison, the S&P 500's average P/E is around 25, so Apple's trading at a premium. Looking at the stock's movement, Apple's 52-week range is $169 to $260. It's down 2.5% in the past week, partly due to tariff news, but up 3.5% over the past month. Analysts have a wide range of price targets, from $139 to $275, with an average of $236. That's about a 14% upside from today's price. Some, like Goldman Sachs, are super bullish, setting targets as high as $270, while others urge caution due to the high valuation. For U.S. investors, this raises a question. Are you comfortable paying a premium for a stock that might not have much room to climb short-term? Or do you believe Apple's growth justifies the price? We'll dive into those growth drivers next. So, what's fueling Apple's growth, and why are so many U.S. investors still excited about Apple? Let's break down the key drivers. First, the services segment is a game changer. Think Apple Music, iCloud, Apple Pay, and Apple TV Plus. Analysts expect services to hit $100 billion annually by the end of 2025, making up a quarter of Apple's revenue. Why does this matter? Services have much higher profit margins than hardware, which means more cash flow to fund innovation and shareholder returns. Second, Apple's pushing hard into AI and virtual reality. The iPhone 16 family introduced advanced AI features, and rumors are swirling about new VR products. Apple's reportedly upping its AI spending to catch up with competitors like Google and Microsoft, which could open new revenue streams. Third, new product launches keep the momentum going. The iPhone 16e, a budget-friendly model, is targeting cost-conscious buyers, potentially boosting market share in emerging markets. Plus, new Macs with M3 chips are driving sales in the PC segment. Finally, Apple's global expansion is a big deal. They're opening more retail stores and growing in countries like India and Vietnam, diversifying away from China. This could help offset tariff risks and tap into new markets. For U.S. investors, these growth drivers show Apple's not resting on its laurels. The company's innovating and diversifying, which is a strong case for long-term growth. But are these enough to outweigh the risks? Let's talk about those next. No investment is risk-free, and Apple's got some big ones U.S. investors need to know about. Let's dive into the challenges. First up, tariffs. Apple reported $800 million in tariff costs in Q3 2025, and they expect $1.1 billion in Q4. These stem from U.S. tariffs on Chinese goods, hitting Apple's supply chain hard. Since a lot of Apple's manufacturing happens in China, these costs could eat into profit margins. Apple's working to diversify production to India and Vietnam, but that comes with higher labor costs and logistical hurdles. Next, regulatory risks. Apple's facing antitrust lawsuits in the US and EU, especially over its App Store policies. The EU's Digital Markets Act is forcing Apple to allow third-party app stores, which could cut into its services revenue. These legal battles make up 21% of Apple's identified risks, slightly above the industry average. Fines or operational changes could hurt the bottom line. Then there's competition. Samsung's killing it in smartphones and TVs, Google's pushing Android and Pixel devices, and Microsoft's dominating in cloud and PCs. Apple's ecosystem is strong, but competitors are innovating fast, especially in AI. Reports suggest Apple's playing catch-up in AI, which could be a concern if they fall behind. Finally, market volatility. The S&P 500's been choppy, and Apple stock dropped 2.5% recently due to tariff news. If the market stays rocky, Apple's high valuation could make it vulnerable to pullbacks. U.S. investors, these risks are real, but Apple's navigated challenges before. The question is, do you think they can keep doing it? One reason U.S. investors love Apple is its commitment to shareholders. Let's talk dividends and buybacks. Apple's paid a dividend for 12 years straight, and in May 2025, they raised it 4% to 26 cents per share. That's not the highest yield out there, about 0.5% at today's price, but it's reliable for income-focused investors. Apple's cash flow, with billions in the bank, supports this dividend, so it's likely safe. Then there's the stock buyback program. In May 2025, Apple authorized a $100 billion buyback after a $110 billion program in 2024. Buybacks reduce the number of shares outstanding, which can boost earnings per share and support the stock price. Since 2012, Apple spent over $600 billion on buybacks, showing they're serious about returning value to shareholders. But there's a catch. Some analysts argue that pouring billions into buybacks could divert funds from R&D, potentially slowing innovation. Others say it's a smart move, given Apple's massive cash reserves. For U.S. investors, the dividend and buyback combo makes Apple attractive, especially for those looking for stability and long-term growth. But do you think Apple should focus more on innovation than buybacks? Let me know in the comments. Alright, let's wrap this up. Should U.S. investors buy Apple stock in 2025? Here's our final verdict. For long-term investors, Apple's a strong pick. Its Q3 2025 earnings show 10% revenue growth, a booming services segment, and AI innovation that could drive future gains. The $100 billion buyback and 26 cents dividend add stability, and Apple's brand loyalty is unmatched. Despite a high P/E ratio of 30.76, the company's track record and growth prospects make it a solid long-term hold. Short-term investors, though, should be cautious. Tariffs costing $1.1 billion in Q4, antitrust lawsuits, and market volatility could lead to price swings. With the stock near $208, waiting for a dip, say, closer to $190, might offer a better entry point. No matter your strategy, diversify your portfolio to manage risk, and consider consulting a financial advisor to tailor this to your goals. Apple's not going anywhere, but timing and risk tolerance matter. That's all from our side. Thanks for watching, and I'll see you in the next one.